All right, I do like to start off the show with a summary of what I saw happening in the stock market this week. This is the chart for the S&P 500 year to date. And really interesting when you look at what's happening so far. Of course, this first half of the year has just finished. This is the worst half of a year start since 1970. So it's kind of a, something that is kind of hard to deal with as far as that goes. We do have to put it in some perspective and realize that, we had 3 years in a row with more than 20% returns on the S&P 500. And really a big portion of that gain came from the stimulus that was put out to fight the economic downturn that was going to come from shutting down the economy due to the pandemic. And now we're paying the price for that as they pull some of that money back, in essence, the Federal Reserve by raising rates and lowering their balance sheets and those types of things. So the real question going forward is, where is it going to go from here? And we'll talk about that some too. But if you look just over my shoulder here, you can see this week we've been basically coming back down, giving back some of the gains that came last week and whatnot too. So, that's going to be the different situations as far as that goes. Now, one of the things that's really important to understand, at least from my philosophy standpoint, is that now over the last couple of weeks, we've switched our methodology of investing. I have three main methods. Number one is a trending upward market like we had in 2020, where you have, things really moving. You want to still have a big chunk of your, portfolio, in my opinion, in broadly diversified stock and bond portions, but have more targeted indexes that you're going after, trying to ride these waves that you see and what have you. And that worked very well in 2020. So far this year, market is coming down, but we don't have precursors that I see to recession, at least up until just recently. And so when you look at this, again, I showed this chart last week, but it's super important to kind of understand this. 5 to 10% downturns happen very frequently, 84 of them since World War II. 10 to 20%, there's 29 of them. But look at the recovery time, 1 month and 4 months. And so you really, until you have a recessionary indicator in place, which we now have some, in my opinion, and I'll show you in a moment, the recovery time is very short. So trying to get defensive or moving out of the market doesn't make sense to me when you only have a 1 to 4 month recovery time. You want to stay in there. And in those periods before the recessionary indicators become, obvious, then you want to be rebalancing a high quality, very diversified portfolio, which is what we've been doing all year. So obviously now we have over 20% downturn. The recovery time for 20 to 40%, you can see, stretches out quite a bit to 14 months. And then, of course, if we end up with one of the really big ones like we've had here, there's only been 3 of those since World War II, it's a 58-month recovery time. So this is when you want to be more, defensive as far as that goes. And so, of course, a recession is a precursor most of the times for these big downturns. And so we want to look at the pre-recession indicators. So first of all, if we look back at that last chart, we're over 20%. So that's a signal, actually. Most of those do have a recession attached to them, not all, but most. And this blue line here is a leading economic index, which I've presented many times. That is now 0.9% off of the high. The gray line there is the actual coincident index, which is where the economy is now. And so if you look at historically, a point in time when the leading economic index was down 1% or more off of its high, the S&P 500 was trading below its 200-day moving average, and the 200-day moving average was going down. You have only 4 other instances where that's happened besides this. And if you look back, one of them was right before the big 73 downturn where the market dropped 48%. Another one was before 1990. That turned out to be a false signal, at least for the stock market. If you look at the 2000, S&P 500 dropped about 45%. And again, this peaked out prior to 2008. And that was a 57% downturn. So that's the concern. It's not a very common situation where you have this indicator peaking out combined with the 200-day moving average situation that's happening with the S&P 500. So that's a period for me to get defensive. That's why we started this. This was released for May on June 17th, and we started to get more defensive with the portfolio. So I just want to reiterate what we're doing and why, because this is very different and actually quite unusual, and we'll see how this plays out. Some of the other indicators are still hanging in there. This is the clear bridge indicator. There's 12 different indicators inside of this overall. If you look, overall signal as of June 15th is still a green arrow, so still expecting expansion. But if you look very closely from the end of March here till now, the June 15th, you're starting to see more and more of the yellow circles and red X's. There's some deterioration that's happening there. And we're seeing the same thing in one of my favorite indicators, which is just the spread between the 3-month and the 10-year treasuries. And so, when the 3-month starts to pay more than the 10-year, that's what's called inverted. We're not seeing that so far year to date. You can see it's still positive at 1.26%. But the trend is troubling to me as it comes down. So far this year, that's the lowest spread between the 10-year and 3-month treasury. So that, it's another piece of the factor there. We'll see what happens as far as that goes, see if it goes inverted or not. Certainly then you'd want to even be more cautious. My outlook is pretty simple here. I look at this as, we're standing on the edge of a cliff, right? And so you're safe in the sense that you haven't fallen off the cliff, but your risk has increased because you're closer to the edge of the cliff. That's exactly how I see what's happening right here. And so what I want to do is kind of put a parachute on, just in case. And that parachute for me is by pulling back some of the stock market exposure that we have, and let's see what happens. If we fall off the cliff, okay, good, we have a parachute, we've reduced the exposure to the stock market. But if we don't fall off the cliff and we back away, then we're safer, then we can go back into our full allocation of stock. But we're right there at the edge right now, in my opinion. And so it's worth looking at and being careful with. And you can kind of see what I'm going to talk about here in terms of the edge by looking at support and resistance. So this is the S&P 500 as represented by a exchange-traded fund through SPDR. The ticker symbol is SPY. This is one of the more heavily traded ETFs that's out there, so I like to look at the volume that's happening here to see support and resistance levels. The green portion on this chart here is the volume profile. Every one of those horizontal bars shows how many shares traded at that price, in this case over the last 2 years. And so I put a little yellow arrow in. You can see what happened this week. We hit resistance that was fairly high, and we failed. We fell off of that resistance and came down. So not enough power, not enough conviction to really get through that. And one of the reasons I'm okay with getting more defensive right here is look at how much overhead resistance we have. Look at how many big green bars we have to get all the way back to the top. And so it's going to be very hard for the market to really go skyrocketing up and run away from us on the upside. Whereas the downside, there's a lot more risk, at least especially when you look at support resistance. We are bouncing off of this last level of support right now. We're having a little bit of a run up today so far, so hopefully we hold up. But it's kind of interesting. We're basically stuck between these two, support and resistance. We're in that little category. But my concern is if you look below, there's a pretty big gap in support, right? So we've got this scenario where the market next high level of support is a little over 11% lower than where we are right now. So that's the cliff. We're standing on the edge of that cliff. We could retest the lows and then really start to come down. And unfortunately, once you get into some of these cascading downturns, there's these periods like we had a few weeks ago where the selling gets pretty dramatic as it comes back down. So again, might not happen, might back away from the cliff, might be safe, but I'm putting a parachute on here. That just makes sense. I'm seeing indicators of a possible recession with the leading economic indicator. I'm seeing some support and resistance pieces there that make me nervous as far as that goes. So what we've done here, and this is our current 60% model portfolio that we are using in our tax-deferred, like IRA type of accounts. So the blue is the stock and the the stock exposure, the 60%, and the green is the 40%, the bond and money market. We still have a very big piece of the Vanguard Total Stock Market Index, which I like, but we now have a 22% exposure to a 1 to 3 month T-bill ETF, ticker symbols BIL. And so again, this is a very conservative, won't move a lot, pays a little bit. The whole objective of this is just to be able to hang in there if the market does come down. And then the next piece we have there is new also, which is our ProShares short S&P 500, ticker symbols SH. This goes up when the S&P 500 goes down. And so those two pieces are there as the parachute. That's the parachute, right? We just want to see what's going to happen. And we still have our Apple and Microsoft components in this particular area. Now, one of the objectives here as we go forward is still to use the rebalancing methodology. But now we have sort of this powerful piece because we have one portion of the portfolio that is kind of fixed with the T-bill, and another portion will actually go up when the market goes down. And so if the market does go down, again, that's still an if, the T-bill portion will become a bigger portion of the portfolio because the other portions are shrinking, and the short portion will become a bigger portion. So when you rebalance, you're putting those back to 22 and 8% and buying Vanguard Total Stock Market, Apple, and Microsoft. And so I've presented this before, but our methodology for finding rebalancing points, this is the VIX. It's a fear indicator. When the fear indicator gets high, that's when you kind of want to step in, especially with the rebalance, because it's fairly small moves that you're making here. And so you can see these are 4 points where we did rebalances in the past. The VIX was over 30 in those cases, and that's one of the things I watch for. And then I also watch for downside stretch in the price. I use this RSI indicator. You can see that there's 4 points there, again, where we did our rebalances where it was at around 30. So, 30 or less for RSCI, 30 or higher for VIX. I'm looking to rebalance. We're not there right now as far as that goes, but it's something I'll be watching for. And again, the power of having that fixed component plus a short component if the market goes down will be that we have this piece that is much more powerful to use to rebalance into those other components that we're holding on to. So this is how you can take advantage of the downturn. And so these are the rebalancing points that match up with those 4 boxes that I just showed you. And at least 3 of them there are really good. Again, the market's come down even farther, but still, it's one of those things you want to just kind of keep rebalancing. You're repurchasing your Apple, your Microsoft, your Vanguard Total Stock Market Index, and you're lowering your average cost. And what that will do is when the market does turn around, your recovery time will be shorter, right? Which is, to me, that's the biggest thing. You can lose 40%, but how fast do you get it back? That's because if you get it back really fast, then what did you lose? Unless you were liquidating on the way down, which some people do to live off of. But if you're able to hang in there, then it's more how long does it take to come back? Because then you've just lost the opportunity to make money during that time. So recovery time is very important right now as far as that goes. And so that's my conversation. Again, I think that you've got a scenario where very important to kind of understand 3 different methods: up market, kind of down market without recession indicators, and down market with recession indicators. There's 3 different methodologies on how you should manage money, in my opinion. And so over the last 2 weeks here, we've been using that run-up that we had last week to kind of sell off little pieces, move into these treasury bills, move into these short positions, and just, see what's going to happen. I'm not positive that things will go down. I think things are more likely to go down, so that's why I'm doing this. But I'm ready to go the other way if things do improve. I mean, one thing that can happen to make things improve is just that inflation kind of drops faster than people expect. And the Federal Reserve is able to really kind of moderate what they're doing. And so, we'll see what happens as far as that goes. So anyway, thank you for listening this week. Really look forward to talking to you next week about kind of what we see then.